This week was supposed to be dominated by meetings of central bank, but drone attack took aim at the oil field in Saudi Arabia and its heat was felt by markets throughout the world. FTSE closed with decline of 46 points. All the major indices of US, Dow, S&P 500, Nasdaq ended in green and Dow was down by 142 points. Asian markets today are following the same trend. Nikkei down by 23 points, Shanghai down by 27 points and Sensex has fallen below 11,000 while Nifty is also down by 68 points. After the attack, 5.7 million barrels of production of oil was affected, which is equivalent to 5% of total world production. Currently, Brent is trading around $68.07 per barrel, while WTI crude is above $61.8 per barrel. Markets are not just concerned about the attack, and it may be a knee-jerk reaction, but there is underlying issue. Market is concerned about how long it will take for production to reach its previous level, as global economy is already slowing. So, if supply remains disrupted for a long time, this might keep prices high for a long time. And in time of slowing economy, high prices will put dent on global economy and its energy needs, and this might even further slow down the global economy. Previously, it appeared that one-third of total lost production will be restored by Monday, but now the reports are emerging that it might take much longer. And Goldman Sachs added, if prices went for 6 weeks, then Brent can go up to as high as $75 per barrel. Experts feel that there is some huge amount of reserve, but the problem is if it stays for quite long, then reserve will fall short. Besides this, there is also issue of rising geopolitical tension. America has stated that it is locked and loaded. Iran also seems like bring it on mode, as America has already stated that Iran is behind the attack. So if things started escalating, then experts feel it might go out of hand and it can also lead to a chance of full-fledged war between US and Iran. Saudi Arabia has backed the proposition of by US and stated that the weapons used in the attacks were actually Iranian. So this has further increased the chance of escalations. So the markets are concerned by both political uncertainty heating up in Gulf area and the impact of high prices on slowing global economy. But both of these factors kept the markets very ahead of times ahead. Airline and shipping stocks across the world were the most affected, as increase in oil price will impact their input cost, and retail stocks also fell as rise in oil price a psychological indicator that things might getting expensive and this might impact the sale of those products. So due to all this bearish trend, overall the markets were down except energy prices. Stocks of energy companies, they were quite high. However, one thing also needs to be considered that there are regions in US where marginal cost of production is around $60. So as WTI has risen above $60 per barrel and it remains there for quite some time, then production might begin from there, and this can compensate the shortage of supply from Saudi for some time. And in that time, let's hope that by that time Saudi Arabia will also start producing at its previous level. China is facing a slowdown, and there is yet another data to solidify it. Industrial production in China grew at the slowest pace in 17 years. IIP grew at mere 4.4%, and general consensus in the market is more stimulus is needed in the market. Trade war is really taking a toll on China's economy, and its premier Li Qiang has also stated that it's going to be very difficult for China to grow at 6%. Reuters have stated that in a report that China has missed a lot of its estimate in recent time. Experts complain that authorities are not doing enough to revive the economy. Since China has a huge amount of debt, so stimulus from physical side do not have much room. So very soon we might expect rate cuts by China. It was added by Reuters that China has missed a lot of economic estimate in recent times, like retail sales, auto sales are down, fixed investment, and all these remain well short of the expectations and analysis. So with this, we can see that economic slowdown in China is deepening, and in response, government action is expected soon. Now, both of this combined factor has actually kept kind of bearish trend in the markets that we are seeing since the yesterday, and same trend is being continued even today. Gold prices rose on Monday as increasing uncertainty brought investors towards safe haven, which is none other than gold. Now, due to that, gold price rose more than 1% on Monday, and by the night, and today it is trading around 15.05, with slightly declined, but we can say it is quite stable and it is waiting for the Fed meeting ahead. While silver is trading close to $18 per ounce at $17.92 per ounce. However, it needs to be noted that beside gold bonds, gold treasury bonds of US are also considered safe haven. Previously, the yield on 10-year treasury US was around 1.5%, but now it has risen to 1.8%, so that will make somewhat less likely for gold to attract all the risk averse investors, as investors will also pour some of the money in bond yields. And India also witnessed shortage of retail demand, and sources reported a discount of up to $51 an ounce is given on gold, and which according to sources is highest since 2016. It is believed that it is expected to revive the demand in October, and till then there were more talks of profit booking, but now this incident actually saw gold prices rising, and now it is stable and it is waiting for the next major event, which is the Fed's meeting, and that will give again the direction to the gold prices. As India imports most of its oil, more than 80% of its total consumption need is met by imports, so rise in price impacted the rupee as more rupee will be paid, and that led to the fall in value of rupee. Hence, rupee closed yesterday at 71.6 and today it opened even lower at 71.8 against dollar. Now, due to fall in rupee, there may be rise in export as India will gain competitive advantage, but its import will also become more expensive, and currently imports are 13 billion more than export, so fall in rupee will impact the imports. And right now there is a very important proposition in economics, which is J curve, and due to J curve it means that there is a lag by the time currency falls and there is a change in exports and import, which basically means it will take some time for people to stop using imported product, and that's why we can see for some quite time ahead, if rupee continues its fall, then trade deficits will definitely rise. This will happen if there is rise in oil price for substantial amount of time, that is important, and also rupee remains depreciated for quite some time. FPIs were net sellers on 16 September and they took rupee 751 from Indian markets. Indian stocks closed day with a decline, and today also they are in the decline as Sensex has already fallen below its level of 11,000. That's it for right now. Bureau Report, Market Times TV.
आपको अगर हमारा वीडियो पसंद आया है तो इसे लाइक करें, साथ ही YouTube चैनल को सब्सक्राइब कीजिए और मोर अपडेट्स जानने के लिए बेल आइकन को दबाना ना भूलें।